Hello and welcome to another instalment of the Self-Managed Super Fund Industry Roundtable series. I'm your host, Michael Killicoat from BRR Media, and today we'll be talking about changes in SMSF regulation. And joining me once again is my regular guest, Mr. Ben Anderson, Managing Director of Future Estate. Welcome, Ben.
Thanks for having me, Michael. It's always a pleasure.
And joining me for the second time today is Mr. Ashley Course, Director of ARC Super. Welcome back, Ashley.
Thanks, Michael. Thanks for having me.
Now, if we can get things started by talking about the Cooper Review, firstly, what was this review all about?
Well, in 2009, the Australian Government commissioned a review into the Australian superannuation system. The review came up with 29 recommendations, of which the government supported or accepted 26 of those, and therefore implemented procedures and consulted industry on how those 26 would be enacted. As a result of that, we're here today to talk about some of those major recommendations that have been supported. In particular, we want to focus on 3 of them, and we'll give you an overview into 6 of the other key recommendations resulting from the Cooper Review.
Okay, and what were some of the key recommendations?
Okay, well today we want to talk about, we want to go into a little bit of detail about 3 of the what we believe the main changes, and also give an overview of half a dozen other changes. We'll get into those 3 main changes shortly, but before we do, some of the other changes we want to talk about may, for instance, the first one I'll mention is, which doesn't directly have an impact on the trustees, but indirectly through the increased requirements that the professionals must meet, could flow on to increased fees for super fund trustees potentially. And that is the requirement for auditors of SMSFs to go through a lot more onerous registration and training and competency requirements. Accountants and anyone who is providing advice in this area is going to need to have a licence, something they haven't done in the past or been required to have in the past. One of the big problems the ATO has identified is the illegal early release of super funds. There are scheme promoters out there who are coming up with schemes to enable trustees to access their super balances early. That's one of the worst things that you could possibly get caught doing. And if you're a trustee and you have been found to have accessed your super early, the consequences are potentially 45% tax on your balance of the fund, and the fund is made non-compliant. The investment strategies now of trustees have to also consider insurance, TPD and life. That's not going to have a major impact. Trustees will now just have to have a minute or some sort of documentation to say they've considered the insurance. And the other one I wanted to talk about is, which has been put into the, I suppose, too hard basket and transferred or pushed back another year, is the requirement for in-specie contributions to be sold and purchased where a market exists. That is, for listed shares, if a market exists, no longer can these shares be transferred in specie into the super fund. So they're the main ones that we won't go into any more detail.
So I think historically people have been able to, if you own shares in your own name, you've been able to effectively sell them to your super fund without them being sold into the market and your super fund purchasing them. So that's that now is going to be phased out. And the rationale, I think, for that is primarily to ensure that people are not using that in-specie contribution via selling shares directly to your super fund as a means to artificially make those share transfers at a lower price, which in effect enables greater contribution to the fund. So I think that's the rationale for that, but it's obviously a big change that will impact nearly every super fund holding direct shares.
So they're the ones that are yet to be enacted. What about the ones that have already been enacted?
Okay, the first one that could potentially have one of the first ones to be enacted is the requirement for super fund assets to be valued at market value. Now that might seem as though it's an obvious requirement, and in fact historically most super funds, self-managed super funds I should say, have already been doing this, because the tax office released guidance a number of years ago suggesting assets should be valued at market value. However, or just recently, in the last month or so, legislation has been passed requiring assets to be valued at market value. A lot of accountants and advisors and trustees are, I suppose, informing their trustees that they have to have a qualified valuer to value these assets, which is not the case. The Tax Office, when the legislation was passed, also released guidance on who can value assets at market value, and I won't go into too much detail, but as long as those assets have been valued at market value and there is appropriate supporting documentation to support that valuation, the trustees technically are able to value the assets themselves. And now that...
So I think though it's interesting for a trustee some of the factors that should be considered there. So if we're talking about property, for example, you don't need a registered valuer to sign off on a certified valuation. Okay, that's kind of clear. But the valuer, whoever that is, and could be anyone, doesn't require a formal qualification, needs to undertake a proper assessment which takes into account all relevant factors and that has been undertaken in good faith and that there's a rational basis for all of that, and it needs to be documented in a way that's capable of explanation to somebody else. And so if a trustee hypothetically were to undertake that exercise themselves, they would theoretically be entitled to. You'd want to be quite careful about how you go about that and how it's actually structured so that it does meet those criteria. I mean, what do you think actually if a trustee has, let's say, a property and they wanted to get a market value assessment done, they don't go to a registered valuer, could they just go to their local agent and say, could you tell me what this property's worth? How would...
Well, that's in reality what most people are doing. They're asking their real estate agent to provide a valuation. More often than not, we see a real estate agent provide a one-piece piece of document, you know, a one-page document saying this property is worth X amount of dollars. Now that one-piece documentation is not really supported by the underlying information. In reality, I think that's what most trustees will still do. But as Ben mentioned, that's not required.
So there's really a higher threshold that they're trying to move towards to ensure that it does accurately reflect the market value with a little bit more thought going into it.
Correct. I mean, Ben, you mentioned that you know, in theory, trustees can value these assets. That's correct. But for the sake of where it becomes risky is when you have assets, or you have assets that are in pension, or you have other risk factors around the fund, such as in-house assets. And for the sake of $300 to $600, I'd be getting a qualified valuer when I am in that position, and there are other risk factors, in-house assets, pension, etc. If I've got a fund that's in accumulation phase with property, I myself would be happy to provide sufficient appropriate evidence to support the valuation I as trustee come up with. Yeah, the key is to have that evidence to support your valuation.
That's right. So a detailed analysis needs to be undertaken. So generally trustees would be best advised to seek independent assessment of that valuation, either get a valuation report or seek independent property advice in relation to that property.
Correct.
And in the context of, let's say, an unlisted trust or an investment in a private company or something of that nature, what do you think the relevant steps for a trustee would be for valuation?
Well, that's the tricky one. That's, I suppose, they're always a difficult area to discuss unlisted trusts, unlisted companies, because usually the evidence supporting the valuation in an unlisted vehicle is unaudited, and it is in the accounting industry, we have a one-page document that needs to go on the front page of that one page, those financial statements, that disclaims any reliability on that financial statement to anyone else. So you really, what does it mean for those that have private investments? I suppose it could create further requirements for them to make sure that valuation is further enhanced with more reliable evidence, but time will tell.
And maybe is there a quick example of sort of how it worked before and compare with how it works now?
Okay, before, in reality, because of the ATO guidance, trustees generally were valuing their assets at market value. But in the absence of any legislative requirements, because trustees are the people who determine the accounting policies for their fund, similar to a director would with a company, the trustees could have valued their assets at however they wish to in most circumstances. All that has really changed now has been made legislation as opposed to best practice.
Sure. And if we can just move along, if we can look at the next bit of legislation that has been enacted, changes to contributions. What can you tell us about this?
Okay, well, contributions is a very topical issue. This was not one of the, generally it was not one of the Cooper recommendations. These were changes outside of Cooper, the Cooper review, sorry. The first one, which we've already, I think, talked about in one of our sessions, but I'll mention again, is that from the 2013 financial year, all people, irrespective of your age, are able to contribute only $25. The cap is $25,000 for concessional contributions. It generally will only impact those that, more often than not, are making salary sacrificed amounts, or they're business people that are contributing large amounts at the year end, because once your income reaches approximately $185,000, your employer no longer has an obligation to put money away for you, your 9%. So that's where that problem lies. Another problem relates to this year that trustees need to be careful of. It's not a legislative change, but it is something they should be aware of, is that the 30th of June, when a lot of people will make their year-end contributions, was a Saturday. Now, the tax office have issued rulings to suggest that a contribution is deemed to have been made by the fund the day that it is received. So if on Friday the 29th of June you made a contribution into your super fund via EFT, but it didn't clear until Monday the 2nd of July, that is not going to be able to be counted towards your 2012 financial year. The next change that the government has introduced is what's called the super rich tax, and that means anyone who earns more than $300,000 a year, and that includes investment losses that are added back. It includes any gains that you make on the sale of shares or property if you are in the business of selling and developing property, get added back to your $300,000 salary, or your salary, sorry. So too does your 9% contribution. And anyone who earns more than $300,000 is going to have their contributions taxed at 30%, as opposed to 15%. I suppose that remains.
So I think the thing that people need to consider around the rich tax, obviously it only impacts, the very top sort of higher earners, but I think that the fact that some of those normal tax benefits you might get in your personal tax environment, such as depreciation or certain fringe benefits or negative gearing in property, are generally added back. So that calculation is different to how it would operate outside of super, and that's something to be aware of, and people should seek advice on that aspect. So it could mean that if your taxable income in your personal name might theoretically be $250,000, you could actually end up using the new calculation, end up over that $300,000, and the impact would be that you're paying obviously twice the rate of tax on those contributions.
So it sounds like maybe not as beneficial to investors as it was before if you're earning that much.
That's correct. Yep.
On someone who is contributing up to their $25,000 cap, they're $3,750 a year worse off in tax. The other thing you need to consider, it is such a complex piece of, or a complex requirement. It might be easy for those that are on salary and wages earning more than $300,000, but anyone who's self-employed or have sold assets or in the business of buying and selling, they won't know what their income is until the end of the year when they've done their income tax return. So it's really a complex piece of a complex requirement.
Okay, so just moving along, once again, we are running out of time, but if we just look at collectibles and personal use assets, what can you tell us about the changes here? Okay,
well, Jeremy Cooper actually said funds shouldn't be allowed to hold these assets. The government did not support that recommendation. However, they've passed legislation which makes it makes it incredibly difficult to hold these assets. So they haven't come out and said no, but they've just made legislation so difficult that not many people, I believe, will continue to hold these assets. You should see on your screen a list of what is considered a collectible and personal use asset. Regulations have been added to this to suggest, or to require, I should say, or to prevent trustees from leasing an asset to a related party, a collectible, or personal use asset. The collectible or the personal use asset cannot be stored in the private residence of the super fund or their related parties.
Well, I think the overriding theme of the changes in relation to collectibles are effectively trying to restrict a situation where a trustee might be getting an immediate benefit from the ownership of that collectible item. So whether it be a car and you're driving it around, or an artwork and it's hanging on your wall at home, they're trying to restrict where there's an immediate personal benefit from the ownership of that asset, and it is genuinely treated as an investment such as any other asset. So to be consistent, so for example, property, you can't live in that investment property within super, and an artwork logically shouldn't be able to hang on your wallet home as well, to be consistent with that idea that you're not deriving an immediate benefit from super.
I suppose one of the key things that trustees need to be aware of is that one of the main changes is that trustees have to they probably did already anyway, but now it's a legislative requirement that trustees have these collectibles and personal use assets insured in the fund's name, and the trustees must have a minute documenting why they've chosen to store the asset where they have, and it can't be on the private residence of the trustee's home.
Okay, now we are almost out of time, but just quickly, just these changes we've run through, whether enacted or yet to be enacted, could I just get your thoughts on how they benefit or who they benefit, investors, the industry or the government's tax coffers?
I think the latter is where the main benefit lies. The aim of the Cooper Review or the Stronger Super Review was to make it simpler and less complex. I find it difficult to see how they've achieved that objective.
And I think it's an inevitability, Michael, to a degree. We've got a situation, we've got this enormous pool of superannuation savings. It is even in the tax office's own words, an onshore tax haven. It naturally is going to attract people trying to move more assets into that lower tax environment, and especially where we've got strained government finances, there's always a temptation, I think, to tinker with the edges of some of those benefits that are currently available in terms of tax benefits, and we're certainly seeing that particularly with such things as the rich tax, the reduction in the contributions that can be made and so on, which overall is sort of restricting that tax concession that self-managed super fund trustees benefit from compared to the average person that isn't operating within that lower tax environment.
Okay, I'm afraid we're out of time, but thanks once again to you both, Ben Anderson from Future Estate.
Thank you, Michael.
And Ashley Course from ARC Super.
Thanks, Michael.
Another interesting conversation about SMSF. I'm your host, Michael Killicoat. Thanks for watching.